The Personal Finance Executive Summary, November 13th, 2013. Welcome to Personal Finance. We're pleased to announce a new tool to help you keep your portfolio healthy, a completely redesigned recommended allocation model.
You'll notice that in PF we're now highlighting more than ever before what our recommended allocations are in the growth and income portfolio. You shouldn't put all of your eggs in one basket. That's something that we continually advise investors. And you'll see for both the income and the growth portfolios, we recommend 60% stocks, 20% cash, and 20% bonds.
And now for some breaking news. We have some timely advice for investors who are considering buying Twitter after its recent IPO.
A Twitter IPO is certainly not for everybody. I would only recommend it for aggressive investors. There are better places for you to put your money right now. If you want to invest in a social media stock, LinkedIn would be your best bet. LinkedIn has continually beaten Wall Street's estimates in terms of earnings and revenue, even though it's right now trading at a rich valuation. If you had to invest in a social media stock, I would say that LinkedIn's your best bet. There's nothing inherently wrong with investing in IPOs and even technology IPOs, but when it comes to Twitter, unless you're particularly aggressive and you're willing to shoulder additional risk, I'd shy away from that one.
Returning to your issue of personal finance, we cover the rise of solar power in our feature article, Follow the Sun. The numbers behind solar power tell a sunny story. Year to date, the Market Vectors Solar Energy ETF has 95.4% total returns.
You know, I think investors should put aside any preconceptions that solar power is just for tree-hugging, Birkenstock-wearing environmentalists. Solar power globally is in the midst of a huge boom. Companies like First Solar, SunPower, they've realized tremendous eye-popping gains this year, and they will continue to do so as legislation favorable to solar power continues to get passed in leading-edge states such as California, which is the #1 solar power market in the United States. Countries such as Germany transition away from nuclear power plants and invest many billions of dollars into the solar industry. Solar power is coming down in cost. Photovoltaic cells are getting cheaper and cheaper to produce, and more utilities are signing on to large-scale solar power projects. It all adds up to a continual long-term demand for solar power. Even though these solar power stocks have generated eye-popping gains this year, they're still trading at relatively reasonable valuations, and they've locked in contracts for the rest of 2013 and well into 2014, in fact beyond 2014, that should assure steady growth into the foreseeable future. Whether it's in Germany or in China or here in the United States, these stocks face outsized growth prospects, and so it's not too late to get onto the solar power bandwagon.
And now for this issue's fund focus.
So, fund focus looks at mutual funds that are long-term top performers, and the question we looked at this issue was, well, long-term performance is great, but what about funds that beat the market over both the short-term and the long-term? And in addition to that, what about funds that achieve that performance while incurring risk that's equal or less than the market? And to us, that's the sweet spot of investing, to find a mutual fund that beats the market while incurring less risk. So the three funds that we profiled in this issue's fund focus tend to tilt towards small and mid-cap stocks, but while people associate those stocks with greater risk or volatility than the broad market, the management teams at each of these three funds focus on high-quality stocks, and that's what really helps them not only deliver outstanding gains over both short and long-term periods, but preserve capital during downturns.
And now for Market Watch by Chief Investment Strategist Phil Springer. The best big-picture strategy concerning the financial markets now is disarmingly simple. Number 1, don't fight the Fed. Number 2, don't fight the tape. Number 3, control your risk in this funny money environment. Some parts of the markets are clearly overvalued, and after the strong gains of 2013, a modest stock market correction should be expected. It could happen for any number of reasons, or even for no particular reason. We advise caution on new investments until we see a correction of at least 5%. In the meantime, consider investments that hit new highs several months ago and haven't participated in the latest market run-up. With yields back down again, the same goes for bonds. We continue to advise new purchases only when the yield on 10-year US Treasury issues climbs back to 2.8% or higher. This concludes this issue's executive summary. But before you go, we're currently offering a very special renewal price for the viewers of our executive summary series. It's a limited time offer for the lowest renewal price available. Click the link next to this video to find out more. And thank you so much for watching the executive summary of Personal Finance.